Welcome to the Chit Chat Stocks podcast, a podcast that helps you discover your next great investment. I'm one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. Brett and I have both been traveling over the last couple of weeks, so we missed last week's Power Hour. We brought you an Ask Us Anything and some interviews instead, but we've got plenty of topics to catch up on. For those that aren't familiar with our format, this is the weekly Power Hour. We go live on YouTube at 5 o'clock Eastern time, typically on Thursdays. We're going a day early this time, but we talk all things financial markets, and we have plenty to discuss this week. We've got 50-year mortgages on the table, stimulus checks are back, some earnings reports for some of our largest companies or our largest portfolio companies, and we've got plenty of questions from listeners as well. So let's go ahead and jump right into things. Brett, how was your trip? Any investing takeaways? And then let's kick things off with the Remitly earnings.
Well, investing takeaways, I guess I should say I was in Japan. Maybe the yen is undervalued. Stuff's cheap over there. It could be a good currency to own. I think a lot of people share that sentiment, but it's been undervalued for many years now. Investing specifically, probably not so much. I don't think it was some wide awakening of what people have their thoughts of what that market is like versus what it actually was with boots on the ground. I think most people's takes are generally in line with that, but I am excited to talk about companies. Well, so some that had some weak earnings, quote unquote weak earnings given the stock reaction, such as Remitly Global, Coupang gets us down a little bit, and I got back with an old flame, Sprouts Farmers Market. I'm excited to talk about them as well.
Oh, you're back together with Sprouts,
I
or
am,
is
and you gotta be
really?
in the, Substack group chat or forum or whatever you call it.
I got
That's
to get
where,
more active.
yeah.
Do you want to kick things off with Remitly earnings, though? We had a lot of people asking us about Remitly. Full disclosure, this is my second largest position, and I believe it's one of your largest positions as well.
I think it's dropped back down to 3. It's over a 10% position even with this recent stock drop. It's in a 55% drawdown this year now. It's been kind of an ugly one. It's been tough to stomach, although it's one that it's kind of an example of, all right, well, if you're gonna invest in high growth stocks that aren't profitable or not as clean as some of the high quality compounders out there and have that quote unquote emerging moat characteristics, you're going to experience drawdowns like this. And it is another good example of, all right, can you experience that without getting emotionally erratic or panicking and stuff like that? And I feel fine now, especially when looking at the underlying numbers here. Let's go through them. Quarterly numbers: revenue was up 25% year over year. Send volume, which is the total amount of money sent through the remittance platform, up 35% year over year to $19.5 billion. I know you gave a good chart on how send volume or either revenue in North America is pretty much closed in now with Western Union. And I would notice here that there is a gap between revenue growth and send volume growth. One, they are reducing the take rate, it seems like, over time, which I think is good as they scale up, but it can help insulate themselves from the competition. It's the classic scaled economy shared that they're trying to go with their customers here, but also they are targeting more high valued senders and businesses, which are going to have lower take rates in general. So they are upping the amount that people can send on the platform, given the fraud stuff they're doing now, or not the fraud stuff they're doing, the fraud protection stuff they're doing, as well as, the small businesses. So all in all, good numbers there. And I'm not concerned that quarterly revenue is growing at a smaller gap than send volume. That's just going to happen. And yeah, Ryan is showing that chart here. Remitly's, what is that? United States and Canada revenue versus Western Union's North America revenue, pretty much closing in on themselves. Quarterly operating margin was just 3%. It keeps growing year over year, but it hasn't grown sequentially for the last 2 quarters. I'd say that's something to watch out for. I would hope that it keeps growing. It might not be linear, just given that they are, right now reinvesting in a lot of new products, stuff like that. I think the big hiccup for investors, I didn't see this out there, but this is just what I would expect, is the initial guide for 2026 was only high teens revenue growth. That's probably means 17 to 18%, something like that. And they're expecting $1.62 billion in revenue in 2025. So if we look at that high teens revenue growth and just say it's 18%, that is $1.9 billion in revenue in next year. We and again, they haven't gotten here yet, but given the fact that their gross margins are pretty much 60%, and I give them I think they can get a 20% gap operating margin over time. I think they can pretty easily achieve that, given that they're capital light. They're really just right now spending on marketing to acquire customers, which have pretty standard payback periods, plus all the new products they're launching now. If you have $1.9 billion in revenue, 20% operating margin, that's $380 million in earnings. Right now, the enterprise value is $2 billion. So we're looking at look through earnings about 5 times there. The market cap is $2.6 billion. They have a lot of cash on the balance sheet. That means I hope, uh, maybe they won't buy back a lot of stock, but I think they should buy back a lot of stock, and I wouldn't even mind them taking out debt to buy back stock, given that they generate a lot of cash. I, I like the stock a lot here. I didn't really see anything negative about the quarter. It seems like, and I don't have the anecdotes in front of me, they gave some good stats about the initial adoption of the Remitly One subscription, where you have the Remitly wallet where you can store money, you can do the send now, pay later, and then you can do the debit card that you can spend money with that internationally with no foreign transaction fees. So, am I going to add? w- I haven't bought any more yet, but as I keep adding more cash to my brokerage account each month, I could definitely see myself adding here. Probably if I'm starting from zero, this is my number one opportunity at the moment.
Yeah, I really like the setup here. Remitly, to put some numbers on it, it really has lost like it seems like investors have kind of given up on Remitly, and the narrative is pretty poor, I think, for most remittance providers generally. But if you just look at like pure revenue growth and the trajectory of operating margins, and you had no idea what the business was, what they did, you just looked at like the unit economics, the improvement in margins, and the revenue growth, it would get a much higher multiple than it does. To put an actual ratio on it, enterprise value to adjusted EBITDA, which I know is a flawed metric, but for a software company that is scaling over time, adjusted EBITDA should be a leading indicator. Now, it depends how generous they are with stock-based compensation and some of those other adjustments, but it honestly, there is some validity to that metric for software companies, especially one that is growing. EV to adjusted EBITDA is 9.3 times. It's pretty rare that you see a company who is growing revenue. Let me just find the figure. They have grown revenue by 54% annually over the last 5 or 6 years, probably going to be more in the high teens, mid teens over the next 3 years. And they're scaling to profitability. I think you're right. I mean, they've said that they think they can get to Western Union level margins at least, which was 18% gap operating margins right now. If they do that, this will be a great return for investors. I'm quite confident in that.
Just
Now,
stay patient. Hey, sometimes stocks get dislocated. There's the immigration fears. It's not look, even given the amount of deportations out there, it's not it's a drop in the bucket in the overall number of immigrants out there. And even if the next few quarters are slower than usual, Remitly is taking a lot of market share, and they're growing 35% send volume in a tough industry backdrop.
yeah, i- it's so easy to get shaken out of positions. Here, I'm sharing the total revenue chart for Remitly over the last 5 years. It's phenomenal. They've grown from basically $250 million in quarterly revenue, or sorry, trailing 12-month revenue to 1.5 billion. And like as much money as you pour into marketing, all that, if you grow from 250 million in revenue to 1.5 billion, there's some traction in your business. And that means people are using it. And especially for a software provider or a remittance provider like this. So there's a lot of validity to the business model. It's so easy, I think, to get worried about the narrative and any bearish points, especially when the stock's collapsing. I think the stock is down like 40% or something year to date.
Price can drive narrative. Yep. Yep.
But I think the results are really good here. And I've said this before, but I really love businesses where they are turning the corner to profitability. It's been maybe it's a recent IPO, last 5 years kind of thing. They are still growing the business and they're turning the corner to profitability, and their margin potential is much higher than what investors are giving it credit for, or what investors are willing to wait for. That to me kind of feels like the situation right now is investors don't want to wait around till they get to 20% operating margins. They want to see the cash flow now, and I think you can get really good returns from here. Do we want to move to anything else? I guess on your point, I think you mentioned the buyback. They've got
Yes,
a lot of
which they've done a
cash.
little bit. They've done a little bit so far, so they're not an immune company from Silicon Valley or something like that.
Yeah, and the other part is there's been insider sales, so just executives selling scheduled sales. But
Yeah,
to for a company that has been private for a long time, still founder led, they they oftentimes don't care that much about the price. They just bake this into their income and they just say, "All right, here's my options. I'm not going to be that sensitive to what the price is. I'm going to, purchase them and sell them." And yeah, I don't think there's that much to read into it if it's just a planned sale, but I would hope that over the coming quarters, they become a little more sensitive to it and maybe decide, "Hey, I'm gonna hold off this year, not sell
or
that
buy
extra."
some.
Yeah, not sell that extra 400K or whatever of shares and wait until we get a better price. But yeah, I really like the setup here. There's a couple stocks, maybe I'll go through this towards the end of the episode, that are, I don't know if I'd call them fallen angels, but they've been previously liked by the market, and all of the sudden, over the
Narrative
last
just
couple
flipped,
quarters.
just
Yeah.
flipped. Yeah,
Yeah, here, let's just go through some of these now. Remitly, believe it or not, at one point, I know anyone that's followed us and been a part of owning Remitly as well feels like the narrative's been terrible for a while. They were at one point well received by investors, post IPO. The stock jumped quite a bit, and there was an expensive valuation that we weren't willing to pay. The other ones, Monday.com, down 31% year to date return. I think it's in like a 62% total drawdown. The Trade Desk, one of the worst performing stocks, I believe, in the S&P 500 this year, minus 63% year to date. Constellation Software, out of nowhere, there's been a bit of a narrative shift because that's had a phenomenal narrative for a decade.
well,
And
maybe not out of nowhere. The founder and leader of the business and that created the whole thing basically from scratch has to retire for health reasons. So I think, to be fair, there are some people that are concerned, plus the AI stuff. But hey, I agree with you. It's kind of out of nowhere that the stock's down. What did you say here? Is it
it's not their
24%? That's
that's
their
that's year to
largest.
date. Their largest
Yeah.
drawdown, I think they're down like 35% or more from highs, which is insane that that's their largest drawdown ever, but whatever.
The narrative has definitely flipped and the price just reinforces that where the stock keeps going down, people go, and I do this with, Remitly. I was trying to search, all right, what are people actually worried about with this quarter? And then you kind of come up with stuff yourself, and then it reinforces, oh, well, what's happening here? The price is going down. I'm getting so concerned about this thing that I'm just blowing out of proportion. You have to just take back seat. Don't look at your portfolio every 30 minutes. Trust that the business is doing well. And if the numbers look good, just trust your thesis.
Yeah. One more that would be on there is Duolingo. This was for a short period, it was really liked by investors, and the narrative, despite still pretty solid results, the stock has taken quite a tumble as well. Those are kind of my 5 fallen angels. So And those are my Q3 fallen angels because there's other ones as well, like Adobe, I think falls in that category. Pfizer used to, although I would say that that may have been that they deserve sort of an accounting scandal, and maybe there might have been some fraud there as well, so they
Hmm,
deserve their drawdown.
didn't know.
Uh, but yeah, the 5 there, Monday.com, Remitly, The Trade Desk, Constellation Software, and Duolingo. Do any of those interest you other than Remitly, since I know you're a shareholder?
Yeah, let me just rank them. One, obviously, Remitly, since I'm a shareholder. I'm gonna go two, Constellation Software, just because I respect their business performance so much, and I respect the culture they built. Three, I'll say Money.com, and you're probably about. We can go through your more in-depth numbers on their earnings after this. Four, Duolingo. Five, the Trade Desk. Sorry, Trade Desk. I know there's some big fans out there of the Trade Desk, but I've never really understood where their moat comes from. I know that they have a tiny bit of counter positioning, but you're competing with Amazon, Google, Facebook in their bread and butter, and w- why that deserved 100 times earnings, I'm not sure. Maybe 30 times free cash flow is more comfortable, but yeah, still doesn't do it for me.
Yeah, what surprises me is that a number of these companies, and I don't know if it's just people saying this now that it's down, but they seem to have an AI will disrupt them narrative. Specifically Monday.com, the Trade Desk, or not the Trade Desk, Monday.com, Constellation Software, and Duolingo. People keep talking about AI disrupting Constellation Software, which truth be told makes no sense to me. I don't think that's realistic. Like if I'm some bowling alley, I'm not like, and I want some sort of operational software for my bowling alley, I'm gonna go with a vertical specific software vendor that has done this for a while. I'm not like, I don't have the ability to just whip one up from scratch with AI. I think people are overestimating the impact it could have on Constellation Software's business.
It's possible. I won't pretend to be an expert on the software market. It always kind of have a net neutral take. I never know whether to be bullish or bearish, but I think that makes sense. Do we want to talk a company that grows pretty darn consistently? They're seeing a cash flow and earnings inflection. It's Monday.com. I know they're trending at 20 times free cash flow, and there's going to be the value investors listening. Whoa, what about stock based compensation? What about stock based compensation? I get it, it's there. But take us through the numbers, why you think the stock is down, and whether you're buying.
Yeah, so Monday.com reported earnings on Monday. I think they always do. I don't know if that's intentional or what, but
It's great branding. Great branding right there.
yeah. They currently have an enterprise value to free cash flow multiple of less than 20 times. That is their lowest multiple they've ever had. Yes, a lot of stock-based compensation baked in there. So they are literally just turning the corner to profitability on a GAAP basis. But shares have dropped 15% in the last 5 days. They beat revenue and earnings per share estimates, and then this seems to be sort of a theme this quarter where it's a beat on both the top and bottom line, and then guidance is slightly disappointing, and there's a big reaction. That seemed to be the case here. They are expecting 22 to 23% revenue growth for the fourth quarter, which is a slowdown from 26% year over year revenue growth this quarter. I don't really see what investors are so hung up on and what's driving the big drawdown here. Money.com seems like a really, really well run software company. Revenue has grown at 52% annually over the last 5 years. They have very good retention with their customers as well. So more and more enterprises are adopting Monday.com. Monday.com really kind of started in the small, medium-sized business realm, and it's kind of task management, but really sort of a workflow software for teams and organizations. And now it's really moved into the much larger enterprises. I think enterprise ARR now accounts for a quarter of their business and should probably account for more over the next couple of years. But they're The number of customers contributing more than $50,000 in ARR, which is generally a sign that you make good use of the software when you're willing to spend that much on a tool. They well, maybe I can pull up the specific number on how many they have, but the retention rate is phenomenal for those customers. So it's 117% net retention rate among their highest spending customers, meaning those customers are spending 17% more net on average across the whole customer base e- every year. So whether that's they're expanding the seats, they're eating the pricing power from money.com or price increases, they seem to be more than happy to continue paying. There is a narrative around AI disruption here. Again, I don't think it makes a whole lot of sense. AI disruption, I think for big enterprises, it makes a lot more sense to subscribe to something like this where it's a sticky tool, a whole bunch of people are already using it, and it's really hard to rip and replace this once it's become a big part of the enterprise. So I like where they're at, and once again, I'm a big fan of companies that are just turning the corner to profitability because it seems like there's a big window for mispricings when that happens, and that seems to be the case again. This might be my next research report.
All right. That does sound interesting. And I totally agree with you. There's a lot of people that just go, wow, the PE is 200. And you just go, yeah, well, they have a 1% operating margin with 80% gross margins. They can get to 25, 30% operating margins if they stop reinvesting so much for growth. Yes,
Let me
these companies can be undisciplined on spending sometimes. The SBC, I get it. That's probably Remitly's biggest and probably Money.com's too concern, headwinds, stuff we don't like, but that doesn't make them bad businesses. And once they get lean, the operating leverage can show up rather quickly.
exactly, and I think this is an important thing to remember with software companies. Every single figure, every single line item below the gross profit is manageable. Like, I think that's why software companies tend to get aggressive with marketing spend. They tend to get aggressive with headcount and operational expenses is because when push comes to shove, they can manage that really easily. I say easily, I mean, you have to stomach it as an organization, but let's use Salesforce as an example because they've been kind of the prototypical SaaS company over the last 20 years.
Largest one, yep.
Operating margins went from 0% to 18% for them in 2 years. They can manage everything below the gross profit line if they choose to. So it really is these are I like software businesses. I've come to like them more and more as I've been a part of one where I've been able to realize you can kind of put your foot on the gas pedal as you choose if you're running these companies. So Remitly, money.com, these people that are getting to profitability slowly, I think are doing so intentionally. It's not like they are unable to turn a profit. It's very much a conscious choice.
Yeah, I I agree with that sentiment. On the other hand, though, if you really cared about shareholders at all, you might try to get leaner quicker. There are it seems like you almost need an activist in there every time to kind of pull them to long. And it's not like you have to go, oh, hey, we're going to treat our employees terribly. Maybe just don't Salesforce spend $20 million on Matthew McConaughey ads because he's friends with your CEO, stuff like that. Do we want to move on to more earnings? Do we want to talk? We have some other news items.
Well, I
Buffett's
think this
Thanksgiving
one's
letter, Apple
this one's very
iPhone.
important. The
That
Apple iPhone Pocket. Now, for anyone who didn't see,
I didn't.
Apple had a big product launch this week, and they unveiled the Apple iPhone Pocket. This is a 3D knitted piece of cloth that can hold any iPhone. If that doesn't
As
sound
opposed
like
to
innovation,
2D. That's what they call them.
yeah, I don't know. That's just a part of their press release, I guess. The if this doesn't sound like innovation, I don't know what does. You can get this sock, frankly, is what it looks like. It looks like a sock hanging around someone's shoulder. It's literally like a tiny purse for anyone that needs the visual. You can get this for the small price of just $230. To be clear, there are comparable pieces of apparel for like 15 bucks on Amazon if you are really looking for something like this. Are you buying one of these?
Yeah, no, that's not happening. The only reason I think anyone should upgrade their phone anymore is if your carrier just pays for it, which they seem to do. I don't, I can't still figure out how they make money, these carriers, because they seem to be subsidizing everything. But that's a whole nother question. This is, yeah, I think it just shows where Apple is these days. They're not very innovative. And on another topic that's not related but also related is the fact that Apple is going to be using Gemini, Google slash Alphabet's AI tool or AI language model, however you want to define it, to power Siri going forward. I don't know when that is going to start, but instead of in the olden days, when Apple received $20 billion or more a year to have Google search be the default engine on Safari, this time Apple is paying Google for the ability to access Gemini. I think we're slowly seeing the results of a decade plus of a lack of innovation compared to the other big tech giants that are actually trying to push the envelope on new technology. I mean, look, this is what
That
they're coming out with. It's a satchel.
it is a satchel, a $230 satchel.
You can buy
The
that at 40 times earnings. To be
so
fair, I've short a whole 2 shares of Apple, so I'm biased, but
yeah, well, that's
hasn't worked
uh
out. It hasn't worked out so far.
yeah, it is amazing how fast the narrative on Google changed. Literally 6 months and all of the sudden they've gone from search is dying, Google is screwed to Google is actually the AI leader. They are the only vertically integrated player and they're going to win. It's and now looking back on Google paying to power Safari, it's like the Trojan horse. They are because Google's search results are powering Gemini responses, right? So in a way, it's Apple basically Google's paying to receive the queries on Google search through Safari, and then Apple now pays Gemini to give it to them in a different format to distribute it differently. So Google does seem to be in a good position, and yeah, Apple. Look, I think they're still going to be the fact that the iPhone is still so used, and
Yeah,
that
they'll
doesn't
be
seem to be
fine. I mean,
changing.
yeah.
They're going to be fine, but I would be surprised if they get more than. How about this? 6% annual revenue growth next 5 years. Do you think it's
Under,
higher or lower?
under, easy, easy under. Maybe inflation could hurt that, but I think that's an easy under. Where's it coming from?
Price increases of the iPhone?
But upgrade rates have fallen for excluding one COVID year where they got a bump. They've fallen for 10 or 15 straight years. I forget the exact date. I think it's since 2010, so it might be 15 straight years. What's going to cause that to switch? And there's no new products. They get the bump from the Apple Watch, the AirPods, the iPad, the services. You're going from a 100% margin business from the Google search payment to a cost center with AI. So
Yeah, I mean, they're still gonna make a lot more money from Google than what they're paying out, right? I mean,
sure, yeah, for the time being, but Google search is transitioning to Gemini, so that is going to. It may not take 5 years, but over 20 years, it's probably going to go away.
I'll tell you
What
where
about
it's
you?
gonna
You
come
taking
from, Brett.
over under?
Yeah, Satchel. The Satchel's gonna drive sales growth for this company.
It costs about as much as the watch, right? The AirPods. I do say that when I have been thinking of buying AirPods for the show. So maybe the investor brain and the consumer brain are different, but yeah. Uh I don't even know what to say. Apple, it's tough.
But
It's
you're
tough. I
talking
just
into a
don't really
mic,
see
but
much.
you could have any headphones. You can go pick up $15 headphones on Amazon, right?
Yeah, that's true. That is true. But they are nice. I guess it's probably the best product they've made in a long time.
Yeah. It it feels like Apple's in no man's land for me. There are still so many people that probably buy Apple or own Apple and just have no idea or don't pay attention to the results. I would guess more than 50% of their shareholders do not track the performance of the company
Well, they're
on a
index
quarter.
funds, so
Yeah.
by
Like,
definition, yeah. We
yeah,
had a comment here that says, "What if Gemini 3.0, the upcoming new launch from Alphabet, is so good that it causes investors to no longer believe that OpenAI is going to make its commitments and causes the market to crash? Wouldn't that be ironic?" That's a question from Tyler. I'm gonna tease that and hold it there for the bubble watch segment later, because I think that relates to some of the news reporting that's come out on Anthropic and OpenAI. But I also want to talk about a company that I discussed it in the Substack chat. My newest stock that I bought, Sprouts Farmers Market, a company we owned. I guess both of us owned back in 2020, 2021. The stock has crashed from all-time highs after some slightly weak guidance on comp sales for 20 or Q4 of 2025, and then discussions on 2026 on the conference call. It's down 55% from highs, and I decided to make the plunge. Took it out at an average price of around $78. It's not a huge position yet, but it's one I want to build over time. If we look at the quarterly earnings, it was 13% revenue growth, 5.9% comp store sales growth. They authorized a new $1 billion buyback versus a current market cap of under $8 billion. The problem was that they guided for 0% to 2% comp store sales growth in Q4. But if we look at this chart here, and I can maybe share it as we're talking here,
I'll
it's
share
one
it.
of the reasons why, yeah, maybe Ryan can do it. One of the reasons why I think visualizing numbers is so important when investing, because you can see when you can just understand what's happening with a company. So the comp store sales growth just accelerated greatly last year in Q4 and then Q1 and Q2 of this year. And as I talked about on the call, I think in October they had 13% comp store sales growth. So they are lapping huge growth in Q4 of last year when they really started to see their concept and the revitalization of the grocery store brand take off. And with that in context, the 2-year stack on comp store sales looks fine to me. Even if they go 0 to 3% or something like that over the next few quarters, that's because they're lapping just phenomenal numbers from late 2024 and early 2025. They still have greenfield area to, I'd say, double store count over the next decade. They're closing in on 500 stores, but I think there's plenty of room to reach 1,000 over the next decade. You have durable revenue growth. I think you have stable and possibly, if there's upside here, expanding EBIT margins and a lot of buybacks with the stock trading and EV to EBIT of 13.5. At least when I bought it, I guess it's gone up a tad. So we're at like 14 now. Seems like a layup to me. The risk is margin compression, which will happen if comp store sales growth is lower than their inflationary inputs. That's a risk I'm willing to take, and it's one that I think with this new management team, nah, I guess they're not new anymore, but with the management team that came over in 2019, they've gotten their footing, and they're now putting the accelerator down. I think it really seems like a good risk reward at these levels, and would I have liked to just held it from $20 a share? Sure, but I think this is a plenty good opportunity I would buy if it keeps falling.
Yeah, I think there's a pretty high chance they're able to hit 10% revenue growth over the next annual revenue growth over the next 5 to 10 years, purely, 5%, 6% store growth and 4 to 5% comp store sales growth
They still
on.
talk about the 10% goal for, store count growth, but they haven't hit it yet. I don't know if they're ever gonna hit it. It's fine, but they aspire to 10%.
Yeah, I don't know. Gr It's so hard for physical concepts to grow unit count by at a double-digit percentage pace and not have a lapse in quality,
Especially if
from
you're
what I've
fully
seen.
owned, yeah, and you're not franchising. I think the you're right that the focus should be on, yes, okay, growing at a small rate per year, that 5-6%, but the core focus should be on driving higher volumes at your existing locations. I think with Sprouts, there was an extremely low starting point on per store traffic. And when you look at, and there's been reporting out there of people concerned about the Amazonification of Whole Foods and that becoming more of a, I wouldn't call it discount retailer, but less of the old cachet that Whole Foods has. I think there is a gap to potentially fill there that Sprouts can, excuse me, a gap that Sprouts can potentially fill.
Yeah, I would say it's, probably an uphill battle for Amazon to replace the cachet around Whole Foods being a premium grocer. Now, maybe they can do it because they have so much distribution and they're Amazon, but yeah, there's definitely a narrative that Whole Foods is premium priced. I think
Well, no, I'm not saying I'm saying that people do not they're saying it's becoming commodified and not, for example, the old Whole Foods where you have this, random new item that we found from an organic farmer. And Sprouts does that where they find five, six hundreds of different like sourcing for stuff that's, not the Coca-Colas of the world, not the mass market stuff. That's where people go to these stores and you could start stealing those customers, which I should mention are usually quite high income and recession resilient.
oh, okay, so it's becoming boilerplate, boring commodity-like items from
That's
Amazon,
what the
essentially?
narrative is. There's been a lot of news stories out there, yeah.
It Yeah, my general take here would be groceries big that I wouldn't worry so much. Like, I don't think Sprouts the results of this investment, I don't think come down to competition from Amazon, the same way it didn't come down to competition from Amazon over the last 5 years. They do I think they've carved out an important niche where more and more people are going to find them. It's a pretty popular concept down here in Austin. People like it. It's health focused. The brand's good. You see that in the comp sales over the last few years. I think they do a
It's
good job.
affordable.
Yeah.
Yeah. It's affordable and they're still doing, I believe, 38% gross margin and something like 7 to 8% EBIT margin. So they have the potential to keep expanding that because they're not dealing with the huge players out there in their supply chain. They're not dealing with Coke. They're not dealing with Pepsi. They're not dealing with Procter and Gamble. And they're selling things like vitamins and minerals and health stuff that have way, way better margins than what you're getting extracted from Coca-Cola.
All right. Let's shift gears. Do we want to talk the 50-year mortgage, or do we want to save
Sure.
that?
We can talk about that. What I guess it's maybe not happening because Pulte just snuck it in to the executive office. I don't know if you saw that reporting that everyone else in the administration's mad about that, but let's say it's real. What are your thoughts on it?
My my initial thoughts honestly were as a consumer, I think I'm okay with it. Like we've already got the 30 year. Who cares if you've got the 50 year? Maybe it makes it more affordable. You can always refinance later on. You can probably have some mortgage buyout or lender that switches you from a 50 to a 30 or changes the duration. But I don't think it addresses the problem. I feel like we're just kind of kicking the can down the road on home supply, which seems to be kind of the major issue that's people are kind of afraid to address. So I wouldn't be that upset with it. I probably makes it a cheaper monthly payment. You end up paying more interest over the long term. I saw a lot of people complaining about that. Like, oh,
We
you're
don't
actually
have to take a 50-year mortgage, but I think
yeah.
I saw a number from Resi Club, who, what's his name? He's been on the show before. Lance Lambert. been on the show, housing expert. He did something like you could save on a standard like $2,700 mortgage payment. You could save like $128 a month. Doesn't seem like the math really maths there. And my initial thought was I'm just going to be renting forever because all this stuff, people do not really think ROI on housing whatsoever. They just think, oh, I'm building equity. Okay, good for you.
I
I'll
mean,
stick with
yeah,
stocks.
I do think most people don't buy a home for the ROI. That's
No, so many people. I mean, come
okay.
on.
Home property investors, but I don't think that's most typical home buyers. That's not their primary consideration of, I want this to appreciate in value.
Yeah.
The other
I think it's a middle ground.
the other part, Brett, is you're just in one of the highest home priced areas in the country. So that that is another headwind for you. But I don't see any issue with the 50-year mortgage being an option. Like,
Sure,
it's
if bank wants
if the
what
bank
bank is
wants to
taking
do
that
it.
risk though? What bank is taking that risk? I I mean, there was an example out there of the 100-year Austrian bond that was at a sub 1% interest rate. How they
Yeah.
convinced, people to do this, I'm not sure, but it is now. Do you wanna guess where it's trading now on the dollar or compared to par value because of what inflation has been over the last 5 years?
Uh, I'm trying to rethink how bonds work since I haven't looked at bonds in a long time.
I guess it's a hard one to guess. It's $30 cents on the dollar. They've lost 70% of their value.
Yeah, that
So
makes
that could
a ton of
that
sense.
could happen with 50-year mortgages. Like, who's gonna take that duration risk? That means that you're gonna have a much, much higher interest rate. It's not gonna solve anything.
Yeah, maybe, but isn't there Fannie and Freddie involvement here that's basically government guarantees for these banks?
That doesn't make the interest payment not high.
I know, but they're already taking duration risk with these 30 years.
You're taking yes, significantly more with 50-year.
So what do you think the interest rate difference would be?
Well, people were projecting instead of what is it right now, 6? I actually don't know. Let's just say 6 now. They're saying like 7.5. It's
Again,
a lot.
I don't see the I don't see the issue with this being an option. Banks will obviously have to price it appropriately, which they tend to do. They have a history of doing fairly well with these. They're not idiots. I know, whatever, we can point to '08.
21st century says otherwise, but
I think that was a different issue. But yeah, they'll have to price them appropriately, but offering this, I don't see the issue in it.
sure. Just don't have the government bailing out idiots that on my
No.
behalf. Sorry.
All right. Coupang earnings. Do we want to talk about this? The
Sure. Do you wanna go through the numbers?
Did you read the
Or
conference call? Before we talk about this, did you read the
Mm,
whole conference call?
I think so. I was honestly super jet lagged and read it like I woke up at like 2 AM. I was reading the conference call, so maybe I wasn't focusing on it. Was there anything crazy from it? I don't remember anything notable.
There was a bizarre question at the
Oh.
end where some analyst was like, "Do you wanna speak to this ad campaign you ran, this very
Oh, yeah,
specific
yeah, yeah.
ad
Yep.
campaign you ran for the APEC, like, event?" And Bum Kim was like, "Yeah, we try not to talk about things that don't actually have a material impact on our business on these calls." It's like,
Well, to be fair, they put out a press release, and they never put out press releases for that for anything. So I think the analyst was fair to ask that. It's like, why did you put out a press release for this?
okay, I must
We,
have missed that, but it seemed very like a very specific, odd, out of place question, but if they're gonna put out a press
I
release.
think you, yeah, I think both were awkward about it. I guess I
Yeah.
remember that, but it doesn't matter for the business. What were the numbers, Ryan? I guess what stood out to you?
Yeah, I'll just go through some of the headline numbers here. They had 22% constant currency gross profit growth. Gross profit's kind of the figure we both pay attention to the most. Revenue, I think, was high teens. Let me just pull up the actual Fiscal AI page here. 1 second. Yeah. All right. Sorry. Apologies for this audio. Okay. 18% year over year, 20% foreign exchange neutral revenue growth. That's on a quarterly basis. Gross profit was 20% year over year, 22% FX neutral. EBITDA margins on the product commerce business were solid, 8.8%.
I'm gonna show a chart here, Ryan, for the product commerce adjusted EBITDA, and I know I wish they would report other numbers. These are the numbers we're dealing with. I wish they would just do operating income or something like that. But again, this is what we got to work with, and you can kind of just back into discount a little bit of what the true depreciation amortization should be. We've gone from negative 2020 2021 to closing in on 2.5 billion in earnings from product commerce that is kind of hidden in here because the developing offerings are getting it so much investment. And the market cap, it's only enterprise value, I guess, is only $50 billion or less, actually, probably a little less.
Yeah, if you would have shown me what the e- margin expansion would look like for like when I first bought Coupang, you said, here's what margin expansion is going to look like over the next few years for the product side. I would be very pleased. That's like exactly what I would have hoped for. And then you
Yeah,
see
it's been
reinvestment.
faster than I would have expected.
Yeah, definitely. And there's been a ton of reinvestment into their Taiwanese operation that seems to be the primary drag on gap earnings because they continue to pour money into there. My take here, because I'm sure there's a lot of investors that are unsatisfied with the fact that they are taking so much cash, reinvesting it. They're not showing as much profits today.
Yeah, uncertainty. Yeah.
This is a management team and company who has placed a lot of bets like this in the past and hasn't been afraid to shut them down. They had this, I think they launched or tried to launch in Japan, quickly
Mhm.
realized it wasn't going to work out for them. They pulled back on it. I remember going through some of the other ones. I can't remember all the countries, but there was some other international efforts that they quickly revised and shut down. The fact that they've gone into Taiwan and it's sticking and they're reinvesting more tells me that they're seeing lots of leading indicators that they think this can be sort of replicating their South Korean core e-commerce business. And now they've got the advantage of having done it before and they know what works. Obviously, there's nuances to every market, but they've they can replicate a lot of the same playbook, both logistically for their fulfillment network, but also on the driving customer demand side. So I really like it. I think this is one that I don't pay too much attention quarter to quarter. I trust Bom Kim, and I think it's going to take some time for them to build out the Taiwanese business, but I'm pretty happy with the results. It's not a screaming buy valuation. The stock dropped a bit after earnings, but I'm very comfortable holding here and would potentially be willing to add if the stock continues to drop.
Yeah, valuation seems, I think, pretty good. You gotta be a believer in the margin potential or margin expansion story, but if you get 10% margin, $34 billion in revenue, it's about $3.4 billion in earnings potential. It's not what they are earning, but it's kind of what you could project at scale. Market cap right now, I mean, the market cap's $53 billion. EV is under 50. So I feel like we're closer to 10 times earnings than people would give them credit for. That is stretching some figures there a little bit. But for
You
a
know,
high quality business, one that I think has a wide moat, one that I think still has a long runway for growth, and we always get questions about, well, what about the demographic collapse in South Korea, which is real, but the population might be down 20% in 20 years. That's not something I'm concerned about. I'm worried about the next. When looking at a stock, I'm worried about the next few years.
yeah, it's maybe a potential headwind, but I think they can actually still drive revenue growth out of their existing population. Even if they don't grow customers, even if customers shrink, I think they can grow wallet share with their existing customers by continuing to improve their offering. The owning Coupang today makes me realize how difficult it might have been to own Amazon early on, where they were consistently reinvesting and they never really showed you the margin inflection for pretty much up until damn near 2020 or whenever it was when you saw them go from what was it? Basically 0% margins following COVID to I think 9% operating margins now. They were just constantly keeping operating margins near 0 by choice and reinvesting across the board, especially in the 2000 to 2010 timeframe where there was the logistics and fulfillment build out, where you don't always see the benefits of that and the fulfillment expansion as well. But in the long run, they're serving customers better, faster, cheaper, and doing so in more places. It's going to create value in the long run.
Yeah, I was happy for the quarter. There's some other things we haven't discussed, especially because we've been 2 weeks off here. The Altman interview that slightly crashed the market. Do you remember this from? It was probably right around a week ago.
Was this
What
when
did
he
you think
said
about it?
when someone asked him if he could fulfill his commitments, and then he said,
Got very sassy. Yeah,
"Yeah," and he
One of his investors and biggest vocal champions, I would say, Brad Gerstner.
it felt weird that it
That's an
almost felt
understatement.
yeah, it almost felt like a personal attack towards Gerstner when he asked this question. Like, Altman reacted in a way where it was like, "Well, maybe you should just sell your shares then. You're privileged to even be an owner here." And, like,
I'd
it
sell. It's $500 billion value. Take
and
your
then
money and run,
I
Gerstner.
would've I would've expected someone I would have expected I don't know, Gerstner basically turned apologetic and was like, "No, no, no, I wanna keep buying. Don't force me to sell." I was like,
It's
"Alright,
tough.
dude."
It's a lot like a live recording. It's kinda you
Yeah,
don't
you
wanna
don't
turn
wanna
into a whole
hurt his
thing, but
feelings. But he was like, "I can't wait till we're public so that I can just tell people to short the stock."
I know,
Like,
it's like
I
you're
think that
already turning into Alex Karp.
I know, it's
That was 10 red flags in one interview.
it it is
Yeah.
an obviously absurd amount of spending commitments. Now, how those spending commitments actually play out and what the contingencies are in those contracts as to whether or not they can revoke them and all this stuff, and whether or not it's basically just hype, I don't think a lot of people know, myself included. But it feels like a very reasonable question to ask and one that I am sure Altman has been asked before. So
Yeah. One
why
you
did
should
he
be
seem
willing to
so hurt
answer.
by it? Yeah.
Yeah, it's perplexing, and I will say again, the over the last 5 years, I guess it's been a little bit less since he's become famous. There has been time and time again, Altman has told you you should not trust him. Why would you invest? Why would you invest in any company that's reliant on OpenAI? Good luck.
Wait, what do you mean?
Like Oracle or something like that. Like, "Oh, we're
Oh,
gonna
okay.
double Oracle's market cap because they have a $300 billion commitment from OpenAI." Again, good luck.
Yeah. And it's not as if OpenAI like ChatGPT has become very much a verb. It is still the leading LLM for consumers. It's the most downloaded LLM app. It is the most used.
I should say losing market share consumer-wise to Gemini and losing market share business-wise to Anthropic.
Losing market share, yes. Still gaining
It's a growing
customers.
pie. Sure, sure, yeah.
The uh, so it's not like the core business is bad, and there's a lot of businesses or sorry, the core products.
Right, yeah,
We can talk
yeah,
about
yeah, we're talking about business, yeah.
economics in a second. The core products, they deliver a lot of value for customers and a lot of value for businesses, but it just I don't I don't understand the need to take it to such an extreme. To I mean, they could have very easily, I think, produced these results without all of a sudden saying, "We're gonna spend $1.4 trillion dollars." Like, I don't think that had any impact on how many customers use their product.
Uh,
You think them being hyper aggressive has been better
will
for the
help them?
business?
No, no, but I'm saying they're thinking that they need to be to match demand, and they just don't have the efficient compute like Alphabet. Do you want I put the notes here, you probably saw them. There was reporting on both Anthropic and OpenAI's spending and revenue and profit timelines, which Anthropic, I guess, is underrated as an important player here, but given that like the top 20 market cap companies in the world are pretty much all reliant on this, it's very, very important for the entire market. I think people should have interest in it. There was a stark contrast in the projections. One, we have Anthropic here, quote, Anthropic, which has a growing number of business users because of the capabilities of its Claude chatbot, expects to break even for the first time in 2028. By contrast, OpenAI forecasts its operating losses that year, so 2028, to swell to $74 billion or a 75% negative operating margin, thanks to ballooning spending on computing costs. The ChatGPT maker also expects to burn through roughly 14 times as much cash as Anthropic before turning a profit in 2030. Don't worry, it's just going to be a quick $74 billion loss, and then 2 years later, we're going to turn a profit. It'll all be fine.
But don't you dare sell your shares, or else
Don't, yeah,
you
don't
can't
get,
be friends with Altman anymore.
I know, at 30 times revenue. Yeah.
Anthropic. So Claude, I believe they're more popular with developers. That's kind of the
Yeah.
biggest
Yeah. That's what
business
I meant
driver
by
for them.
business. Yeah. Yeah. I guess.
I was a little anecdotal evidence here from my week in office last week. Spent some time with a lot of the developers, and I was pretty blown away by the amount of AI usage in the developer's workflow. Like, it's not, I think people picture someone saying, "Hey, ChatGPT, write me code for this product or whatever." Obviously, that's not how it actually happens, but you can do all of your planning. You can do a lot of the actual lines of code being written using uh, generation models, and then basically become an editor for it. Obviously, you have to have the knowledge to know whether or not what was written is actually useful. But I was pretty blown away by the use cases, and in general came away a little more optimistic for specifically the developer geared models. Anthropic being, I guess, the leader there.
Yeah. And that's why they're growing so quickly right now.
The other thing I didn't realize, another anecdotal evidence here, I didn't realize that cloud, i- there is some bit of commodity elements to it. Like some providers, GCP versus AWS, you might use them for different workflows, but you are very much competing for startup dollars, and they will continue to just basically give startups credits, trying to hook them onto whatever their business is. So I don't know, it made me a little more when I think about like clouds just continuing to see operating leverage, like AWS, Azure, GCP. I think there's this threshold there. There's probably a ceiling, not only on the depreciation of GPUs, but there's serious competition between those big three.
Speaking of which, and this is a jam-packed bubble watch. Did you see the famous Michael Burry from Big Short fame being vocal about his short bets on, I think, Nvidia and Palantir? Although there's probably some misunderstanding about the nominal values of what put options are on, when you look up the 13F on Whale Wisdom, or I should say Fiscal AI. I think Michael Burry's included in the super investors there. Uh, what are your thoughts here? He seems pretty vocal on the depreciation stuff and seems to think this is very unsustainable.
I don't know what to think of the depreciation schedules because I have heard people cite that a lot of the 5-year-old, 6-year-old TPUs or GPUs still get good usage. They just revise what workflows they're going towards. Obviously, I don't follow the actual accounting depreciation schedules. I think it's a 6-year useful life is what Google had for their TPUs or GPUs. Can't remember. But it doesn't seem like something all these businesses would like feel
Well, it boosts
inclined to lie
earnings. I
about it.
mean, there's
No,
incentive. Yeah, it boosts earnings, so there's an incentive.
I know, but it's just kicking a can down the road for them later
Are you
on.
saying you would be surprised at a management team kicking the cans down the road to boost earnings in the short term to maximize their bonuses? I mean, this is management 101.
Yeah, but all of them are significant shareholders still running the company. Jassie's a big shareholder. Sundar Pichai, I imagine, is a big shareholder. I honestly don't see them being management teams that are trying to create bigger problems for their organization down the road. I really there are obviously a lot of management teams do that. I don't think Sundar Pichai, Satya Nadella, and Jassy are all doing that.
Yeah, I guess they're the only ones that know. Uh, I'm not gonna pretend to know what
Also,
GPU should be depreciated at.
there is auditing here, right?
By 23-year-olds from KPMG.
No, no, come on. There's people that are looking at this that it's not like they just make up their own useful life number and people are forced to go
A
with it.
lot a
Surely that
lot of
can't be the way.
accounting is just is estimates. It's estimates. There can be wide ranges on estimates.
I mean, I would be surprised if all the GPUs, TPUs from 5 years ago are sitting in the trash.
No, that is fair, and they're the ones that should know better than anyone. It's just no one is gonna know except for the people that work in the big tech infrastructure. They're the ones that know.
Yeah,
We'll
but
see. Either the cash flow is gonna show up or not.
yeah, that's true. The But as for the short positions, I think people give too much thought to Michael Burry's short positions. He moves in and out of things very quickly, and he probably has different motivations. You don't know what the options were. Like, you don't actually know the exact options trade. You
Yeah,
just know the
it's all
notional value.
13Fs are hard to analyze.
Yeah, especially for people that primarily deal in options.
But he is, I believe, posting screenshots from The Big Short movie, so
Hey, Lululemon shareholder.
that's a psychological alarm for me. And I guess I have a sneaking feeling, oh wow, it's back down to 170. Maybe I can still get in. I have a sneaking feeling I should have done Crocs and Lululemon for the apparel rule breaker, but just Crocs for now. And I guess we can talk about them another week, but yeah. All right, we're going long. We didn't get to Buffett's letter. We'll maybe get that to another time. There wasn't that much there, but we also have stuff around credit cards, people asking about Portillo's, Constellation Software. So plenty of stuff, and Axon Enterprise, which could be a fun one to look at next week. We'll have plenty of stuff to discuss on next week's Power Hour. Thank you to everyone that joined the live episode. We'll typically do these Thursday, 5 p.m. Eastern time. If not, it'll likely be on a Wednesday at 5 p.m. Eastern time. But you can come live. These come out Friday mornings, and you can listen wherever you get your podcast, YouTube, Spotify, Apple Podcast, even Amazon, somewhere else. But let's hit the disclosure and get out of here. We are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in once again and asking questions, and we'll see you next time.